So just to sort of give you a bit of introduction as to the purpose of today, really. Obviously, Asher Harris is our key speaker this morning. I've known Asher for probably 3 or 4 years. He and I met kind of sort of on the tax captive circuit, I guess, a few years ago, and sort of stayed in touch. And FET has been something that we've discussed on and off over the last few years. Just a bit of background on Asher. He's based in New York. He's a tax attorney. He runs his own tax practice in New York. Prior to being sort of self-employed, he's worked in the insurance industry for a number of years. And certainly FET is one of the things he sort of specialises in, advising captives and insurance companies. What seems to have happened, I think, is the IRS in the US, I mean, have I think probably fair to say, making a few waves with regard to FET recently. There's legislation in place that has been in place for a number of years, and it seems like they're sort of looking at this legislation and figuring out how they can maybe enforce it. I think it's probably fair to say that all the treasuries across the world are looking at more revenue, more sources of revenue. So I think this is an example of the US Treasury maybe looking at ways of generating more tax dollars. Asher called me a few weeks ago and said that he wanted to come over to Dublin anyway to do a few meetings and a bit of marketing. So we sort of thought, well, this is a great opportunity really to tie the two together. So we persuaded Asher to make a presentation here this morning on FET, and obviously to discuss any issues that you may have. I think we've probably arranged meetings with a few of you over the next couple of days, but Asher is around for the rest of today as well. So if there's anything in particular that you are keen to discuss with him sort of outside of this meeting, please come and find us afterwards, and we can sort of put a bit of time aside over the course of today, so you can sort of discuss any particular issues you have with Asher. Before we hand over to Asher, I mean, I think that from Fiscal Reps perspective, obviously we're delighted that he's sort of volunteered to speak today. Whilst sort of European taxes has always kind of been our main focus over the past few years, we've been aware of tax developments outside of Europe to the USA, Canada, Australia, and a few other places. And obviously from our perspective, to be able to sort of partner with a very experienced and knowledgeable tax expert in the US is great for us. Hopefully, our clients will benefit from it as well. So we're sort of delighted to have him here today. So I'm now going to sit down and let Asher take over. Thanks, Asher.
Thank you very much. Thank you very much, Mike. First of all, I'd like to start by thanking all of you for joining me here today. It's a pleasure to be here. I'd like to thank Mike for arranging this, and his whole team. Done a lot of excellent work here, and I really appreciate everything that they've done to put this together. Want to hit some page downs for me? Just try to get out of the sun in the meantime. Okay, one more time. Okay, so I'd like just to start briefly by going through some of the things that we're going to be talking about today. First of all, what I'd like to do is, just as an introduction, is just talk about the basics of the federal excise tax imposed by the United States, just to make sure that we have a common understanding and everybody knows sort of the basic principles that we're going to be discussing. One of the key issues in federal excise tax is the treaty exemption, so we'll be discussing to some extent the tax treaties that provide for exemptions from the federal excise tax. And then we'll be moving on to specifically the cascading excise tax, the revenue ruling and announcement that came out a little while ago, as well as the recent audit activity that has brought this somewhat to the forefront. We'll then be talking about some other issues that relate specifically to federal excise tax. They may not have been quite as gotten as much notoriety as the cascading excise tax, but they're kind of interesting things to keep in mind as people try to deal with this situation. And then finally, what we'd like to do is briefly talk about, what kind of impact is this going to have? What are the appropriate responses? What type of strategies or issues should people be thinking about as a way to deal with this? Okay, let's talk a little bit about the basics of federal excise tax. Under the United States law, there's an excise tax imposed on insurance premiums or reinsurance premiums. that are paid to a non-US insurer on US risks. The rate is 4% of the premium on non-life and 1% of the premium on life insurance or on reinsurance. And if you look at sort of the basic principle that is articulated in the first bullet point, you can kind of see where the roots of the cascading excise tax are going to come in. Because what happens is that the Internal Revenue Code says whenever there's a premium paid to a non-US insurer on a US risk, that the tax is due. And there's a sort of an inherent ambiguity there. Most people would sort of intuitively think that you're talking about a situation where there's somebody inside the United States who's paying a premium to somebody outside the United States. And, you know, frankly, I think most of the people within the industry assume that that's what they meant when they wrote it, and assume that that's really what it means. But when the IRS looked at this and read it technically, they said, well, it doesn't really say anywhere that it only refers to people inside the US. It talks about anybody paying a premium to a non-US insurer. So that could be one non-US insurer paying to another non-US insurer. So there's this ambiguity in the way that the phraseology of the tax is put into place that leads to this whole debate. And I think, frankly, the more natural reading of the Internal Revenue Code is to say that it really does only apply if the person making the payment is a U.S. person. It's kind of the natural reading of any tax code, but it's sort of one detail that got left out of the code. One point that I think is interesting to make, it's sort of a historical perspective. The federal excise tax on insurance premiums is one of the oldest taxes in the United States. It was originally imposed in the late 19th century to help the United States repay the debt that was borrowed to finance the Civil War. And it predates the U.S. income tax. And a lot of the issues relating to the administration of the excise tax really derive from the fact that it is such an old tax. It's been relegated to sort of the back corners of the Internal Revenue Code, never received an enormous amount of attention. And the terminologies that are used, the phraseology that's used in the code, it really looks like something that was written in the late 1900s, in the late 1800s, excuse me. And it's never been updated, and because of that, it really just doesn't fit neatly into some of the other provisions of the Internal Revenue Code. The other point about it that's interesting is that it was originally literally a stamp tax, so that if a person bought an insurance policy from a non-US insurer, they would have to go to an institution that was authorized to issue stamps on behalf of the United States government, which was typically banks. You would go to the bank, you would figure out how much money you were going to pay on your insurance policy. You would go to the teller, buy a stamp, punch out a hole in the middle, and affix it physically to the insurance policy. And that's how the tax was paid, administered, and if you didn't have a stamp on it, the policy wasn't enforceable. Much, much later in its history, seems only 30 or 40 years ago, that stamp process was eliminated and it went to a more traditional system where you fill out a tax return periodically and figure out how much money you owe and send the money into the government. But its roots of the way the regulations are drafted, the way the rules are written, all those issues relate to the fact that it was originally a stamp tax. And as we'll see as you go through it, you can sort of see the roots of the tax and its basis as a stamp tax that still give rise to some of the fundamental ambiguities today. Okay, one of the critical features of the US Federal Excise Tax is the fact that there are many tax treaties that the United States has which allow the payor to make a payment to a foreign insurer or reinsurer free of the excise tax if the insurer is a resident of the foreign country and if it qualifies for treaty benefits. Now, one part of the United States tax treaty jurisprudence that's very, very important. The United States insists on every treaty having what's called a limitation on benefits clause. And what that does is that it limits the benefits of the tax treaty to those entities that are not only resident of the foreign country, but are also meet certain ownership requirements or certain other types of requirements that are allowed. So for example, the Irish treaty, the tax treaty between the United States and Ireland, has a FET waiver as part of it. So in theory, one might think that anybody in the world could just open up, come to Ireland, try to get an insurance license, form an insurer here in Ireland, perhaps not even have an office here. You could have your office wherever you want, but just have something that was technically an Irish company and thereby qualify for the benefits of the treaty. You can't do that, and that's really what the limitation on benefits articles are meant to restrict. They're meant to restrict what we refer to as treaty shopping, a situation where a corporation that exists in a country with which the United States does not have a tax treaty, forming essentially a shell corporation or shell subsidiary in some other country just in order to gain the benefits of the tax treaty. So whenever you're thinking about federal excise tax and the application of a treaty, both from the perspective of the person paying the premium as well as from the insurer who's receiving the premium, you've got to really take into account and consideration whether or not the limitation on benefits article is going to be met. The other very, very important part is that the treaties typically only apply if the insurance premiums are not then reinsured to a non-qualifying reinsurer. So that, for example, if going back to the example that we just discussed, if you have an entity that qualifies for the FET waiver, but it essentially acts as a front, it just issues a reinsurance policy and then retrocedes it all out to a non-qualifying insurer, in that situation, the treaty itself explicitly states that the FET waiver does not apply. And we'll go through an example of how that works just to make sure that we're all on the same page. And then finally, an insurance company that does qualify for the benefits of the treaty will often enter into what's called a closing agreement with the Internal Revenue Service, which is basically an agreement under which the insurer agrees that it represents to the Internal Revenue Service that it qualifies for the treaty exemption, and it agrees to provide the Internal Revenue Service with books and records in order for the service to track whether or not the insurance premiums that are coming in, purportedly free of the FET, are then being reinsured out in a way that would disqualify the waiver. One thing that's very important to keep in mind, though, is that the closing agreement doesn't establish the exemption under the treaty, it merely confirms it. By confirming it, what it does is it gives the payor of the premium the ability to be confident that the recipient is actually eligible for the treaty exemption. So for example, you have, as is often the case, you may have a Bermuda parent that has an Irish subsidiary. The Irish sub will enter into a closing agreement. Now if you have a US insurance company that's reinsuring with the Irish sub, as long as they know that the closing agreement is in place, the US payor is then confident that it can make the payment without having to withhold the excise tax. But it's really confirmation. If you don't have a closing agreement and you qualify for the treaty, you still qualify for the treaty.